Hello, everybody. It's Trevor again at Heritage Reverse Mortgage. I am a reverse mortgage specialist. I want to take a minute and thank all of you for watching our videos. I know that reverse mortgages are not the most exciting of topics to talk about, but for those of you who have a reverse mortgage or who are considering getting one for yourself or someone you love, I know that sometimes this information can be very helpful. And so, really, we just want to help you to understand this product so you can get the absolute most out of it. For people who have a reverse mortgage and use it to its fullest benefit, it is a life changer. It really will make your life better. The video that I'm recording today and the article that we're posting has to do with the big changes that came out this year from FHA and HUD that affect the reverse mortgage industry. Now, this is a little bit more in depth than most of you really need to know or understand, but I still feel it's important if you're getting a reverse mortgage during this transition period, this may affect you. Now, what's happened is every year around September or December and December, FHA and HUD usually like to come out with some surprises, changes to the product, changes to the industry. Most years those changes aren't that big of a deal, but some years they're pretty big. And this year was one of those where we had a big surprise, but fortunately, as the dust settles, it's not turning out to be that big of a deal. The differences or the changes that for over a decade now, reverse mortgages, line of credits have been governed or been using an index called the Libor, and that's the London Interbank Offering Rate. The Libor is an index that is used on adjustable rate mortgages, and the line of credit is always an adjustable mortgage. And so this index has been used to gauge what interest rate adjustments would be from year to year. Problem is that a few years ago it was discovered that the Libor was being tampered with, or was being manipulated by the various governments and countries that play into it. And so FHA determined that by the end of 2021, they were going to move away from the Libor. They were going to go to an index that was a little bit more reliable and not prone to manipulation. So we thought we had another year to adjust to this. Unfortunately, they came out in September and said, we're done. By December 31st, any reverse mortgages that are not closed will have to move to a different index. And the new index, or the temporary index, is the CMT, or the constant maturity rate. The difference is that the constant maturity rate is based on just the Fed funds rate, or the US Treasury markets. And so it's a little bit more stable, it's a little bit more reliable. The problem is that this really shook up the whole industry. In general, there are pros and cons to each. Initially, the problem that scared us mostly was that the Libor offered an interest rate that could adjust only once a year and was capped on its adjustments of 2% per year, 5% maximum for life. And the CMT, on the other hand, only had monthly adjustable options where it could adjust every month. There were no annual caps, and there was a 10% lifetime cap. And so when they first announced this kind of threw me for a loop, especially because I have a lot of clients, and likewise, the adjustable rate isn't always a bad thing, but having that kind of flexibility for rates to really shoot up kind of made me nervous. Fortunately, the banks came out rather quickly and said, we're going to create a product that has those same caps. And so the CMT now does have an annual adjusting option. It does have 2% annual caps and 5% lifetime caps. And so in the end, the dust is settled, and the final product is actually really better than the previous product. The CMT has lower interest rates in general. It has lower adjustments in general. It's more constant and secure. And so I think it's a wonderful product. I think it's an improvement for our industry. One of the benefits that I personally got out of this is it really forced me to dig in and examine the historical adjustments in interest rates. And it's interesting, what I found is that, we generally think that fixed rates are the way to go. You want to get a fixed rate, you want to be locked in forever on that. But what I found is that for people who did a reverse mortgage maybe 20 years ago, I contrasted these side by side, a fixed rate, a annual adjusting interest rate, or a monthly adjusting interest rate, and it surprised me. In all four instances, a 20-year analysis, a 15-year analysis, a 10, and a 5-year analysis, in all four analyses that I did, the monthly adjusting interest rate was the best choice. It saved more money by far than than the fixed rate for sure. On a $100,000 loan 20 years ago, the monthly adjustable interest rate would have saved a homeowner $50,000 plus versus a fixed rate. And so I throw that in at the end of this video because for a lot of you, I know that you're likewise of that mindset that a fixed rate is the way to go. But that's something we really want to examine in your situation to make sure that really is the case. Because as I mentioned, history shows us it's actually not. A fixed rate would have hurt you dramatically versus the adjustable rate options that would have gone down with the market and lower interest rates we've had. I hope this is helpful and beneficial. I know it's a little bit more in depth than you probably need to get on this, but I want you to know that we are reverse mortgage specialists. This is what we do. This is all we do, and we're here to help you if you're ready. Give me a call. Me or someone on my team would love to look at your situation. We'd love to answer your questions and make sure that we're helping you to have all the information to make the right choice. My number is 435-359-9000. You can email us at trevor@heritagehl.com, or you can visit us at heritagereversemortgage.com. Thank you guys. Have a great day, and we'll talk to you soon.